Welcome back to the deep dive. Today we've got a fascinating and pretty stressful stack of sources detailing the Korean financial sector.
It's a lot to take in.
It is. We're looking at these huge institutions caught between two relentless forces.
Right. On one side, you've got aggressive government regulation tightening all the credit levers.
And on the other, you have these major global macro pressures, especially, this massive currency instability that's just eroding their strength from the outside.
It's a classic squeeze, and our mission today is really to cut through that complexity. The sources we have are, they're deep financial reports.
For sure.
They outline everything from bank balance sheets, regulatory compliance actions, to the granular market responses. We really need to help you understand where capital is shifting.
And critically, how this whole regulatory environment is creating these unpredictable ripple effects across the entire financial landscape.
Exactly.
Okay, let's unpack this. Because if there's one overriding theme here,
Yeah.
it's really the law of unintended consequences. Regulators want to slow down lending, but when they push too hard on the major banks, that demand, it doesn't just vanish.
No, it just gets diverted, often to less supervised or, smaller institutions.
We have to start with an immediate crunch point, what we're calling the Great Loan Squeeze. Why are the four behemoth banks, KB Kookmin, Shinhan, Hana, and Woori, suddenly just slamming the doors shut on new lending?
Well, the problem is pretty straightforward. They exceeded their limits dramatically, and that prompted the regulators to step in.
How dramatically are we talking?
For the current measurement period, the major banks had an annual goal for household loan increases of about 5.9 trillion won.
Okay.
But by November 20th, they had already increased their loans by a staggering 7.89 trillion won.
Wow. That's almost 8 trillion won. So they blew past their limit by nearly 33%.
It did, and overshoot that big mandates, immediate, and frankly, painful actions.
Which is why we're seeing these headlines.
Absolutely. It's why KB Kookmin abruptly halted new mortgage applications, and Hana started restricting both standard mortgages and a critical type of loan that's, really unique to Korea, the Jeonse loan.
Okay, hold on. Let's quickly define Jeonse for our listener because it's so different from a standard rent or mortgage.
Good call. Jeonse is a unique lump sum deposit system. So instead of paying monthly rent, the renter gives the landlord a massive deposit.
And we're talking huge, right? Like 50% of the property's value, sometimes more.
Often, yes. The landlord invests that sum and just returns the principal when the lease is up. So a Jeonse loan isn't for buying the house.
It's for the renter to come up with that enormous key money deposit.
Exactly. And when banks restrict those loans, it just freezes up the rental market. It restricts the movement of renters dramatically.
That puts immediate high-stakes pressure on the housing market. So what drove this massive lending surge to begin with? Was it all just real estate speculation?
Not entirely. The source material points to two main drivers. First, some of it was just delayed fallout from housing deals made earlier in the year, where the loans only just got finalized.
Okay, backlog.
But second, and this is highly relevant, there was a major spike in credit loans. People borrowing cash specifically for stock investment.
Just borrowing to play the market, that definitely raises the risk profile.
Precisely. The five major banks saw a 1.38 trillion won increase in just general credit loans during this period. That's the biggest jump in that category since mid-2021.
So household debt is fueling financial market activity.
Right, which forces the major banks to hit the brakes. Hard.
Now, here's where those unintended consequences really kick in. All that demand for housing, for credit, for Jeonse deposits, it has to go somewhere.
It does.
So where's the path of least resistance leading?
It leads straight to the secondary mutual finance sector, most notably these local cooperatives known as unit nonghyups.
And that's a crucial distinction, isn't it? There's the big centralized nonghyup, and then these individual autonomous local branches.
The units, yeah. And those local units still have capacity.
Really?
They do. They have about 1 trillion won remaining in their lending quota. They've only hit about 60–70% of their annual targets.
So they see an opportunity.
A massive one. The surprising detail is that because these unit nonghyups are decentralized and manage their own risk, some are aggressively undercutting the major banks on interest rates.
That feels counterintuitive. You'd expect smaller institutions to charge more for risk, not less.
Traditionally, yes, but in this environment, they're grabbing market share. We're seeing unit nonghyups in high-demand Seoul districts, like the one covering Yongsan and Mapo, offering rates as low as 3.88%.
And how does that compare to the big banks?
Their lowest rates start at 3.98% and go all the way up to 5.51%. So the local co-ops are actually cheaper than the majors right now.
That must be putting intense pressure on the commercial banks. Their customers are basically being given a financial incentive to jump ship.
It creates a tremendous short-term headache, for sure. But the regulatory pressure is also diverting demand into the digital sphere. I mean, the internet banks are just totally swamped.
Tell me about KBank and Kakao Bank. Their systems must be buckling.
KBank had to set daily mortgage limits just to control the volume. Applications just surged when the Big Four stopped.
And Kakao Bank.
Their experience is even more extreme. When they reopened new mortgage applications, their entire daily limit was gone in 2 to 3 hours.
Gone by 9 a.m.
Starting at 6 a.m., yeah.
That is the definition of extreme unmet demand. So let's get back to this idea that the regulatory fix might be creating an even bigger problem down the line.
This is the core structural concern. By aggressively capping loan growth now, you are essentially suppressing legitimate demand.
You're pushing it down like a spring.
Exactly. And when those regulations are inevitably eased, and they always are, that suppressed demand will come roaring back into the market. The financial sector is warning that this prolonged regulation is like a pressure cooker,
Leading to a much more severe and rapid spike in property prices later on.
which is the very thing the regulators were trying to avoid.
So they're in a tough spot. They have to look like they're controlling debt now, even if it means building up volatility for the future. It's a very risky trade-off.
It is.
Okay, let's pivot now. From that domestic regulatory risk to global macro risk. While banks are fighting these loan caps at home, they're also being threatened by a soaring $1 exchange rate.
Right.
We need to talk about capital adequacy. What are RWA and CET1, and why is currency volatility causing them so much pain?
We're moving into the essential metrics of banking stability. RWA is risk-weighted assets. Basically, all the assets a bank holds are given a weight based on how risky they are.
And CET1.
That's the Common Equity Tier 1 ratio. It's the bank's core capital, its most stable equity, measured against that RWA figure. A higher CET1 ratio means the bank is safer.
The mechanism is simple then. If your RWA goes up and your core capital stays the same, the ratio just drops. You look less healthy, even if you haven't actually lost a single one.
Exactly. And the weak one is causing RWA to spike.
Ow.
When the Korean won weakens, a bank's foreign currency assets like overseas investments or loans made in dollars suddenly become worth much more when they're converted back into one for the books,
So it artificially inflates the value of their assets.
which boosts their total RWA.
So banks are losing capital adequacy on paper just because their risk is being counted as higher due to the exchange rate. It's a purely mechanical erosion.
Precisely. And look at the movement. We went from 3,351 per dollar in June to over 4,402 by September. By late November, it has shot up to 1,475.
That rapid sustained weakness is the problem. How has this specifically hit the major players?
It's caused major stress. Shinhan Financial Group saw its RWA increase by 8 trillion won in the third quarter alone. Of that, 1.5 trillion, almost 20%, was just from the exchange rate.
And what did that do to their CET1 ratio?
It caused a 0.06 percentage point drop. Worry Financial Group saw a similar drop, about 0.07 percentage points.
But the sources flagged Hana Financial Group as the hardest hit. A colossal 0.37 percentage point decrease. Why were they so much more exposed?
Hana just handles substantially more foreign currency. They have a larger international portfolio than their peers.
So their RWA calculation is just inherently more sensitive to these currency spikes.
It is. They were hit by a painful double whammy. Exchange rate inflation combined with their own domestic loan growth. It made their capital erosion far steeper.
This highlights a crucial squeeze because the government is also pushing for production finance, more lending to SMEs, which increases RWA.
Well, the external environment is actively undermining the capital base needed to support it. Capital management, as the sources note, is extremely difficult right now.
It requires extreme agility, especially when some forecasts suggest the one could approach the 1,500 mark.
Right. The banks have to balance regulatory demands and macro reality, and they're pulling in opposite directions.
Let's shift our attention now to institutional stability inside that secondary sector, specifically the credit unions or Shinhayup. The Financial Supervisory Service, the FSS, is planning for preemptive restructuring here. Why so proactive?
Well, the FSS is worried about increasing risks, particularly real estate project financing exposure, which is a known vulnerability across that whole sector.
So they're getting ahead of a potential problem.
They're trying to. The FSS director has told them to start classifying potentially failing credit unions and matching them with sound ones before a crisis hits.
This sounds like it's aimed at preventing moral hazard, right? So failing institutions don't just get bailed out without consequences.
Exactly. The current system is often just merging a failing union into a healthy one, which, it dilutes accountability.
And probably demoralizes the healthy institution that has to absorb them.
It can. The FSS is looking for a new method, maybe an acquisition model, where the previous mismanagement actually faces repercussions. And this planning is vital, given that mutual financial institutions have already seen 14 forced mergers this year.
That's a clear signal that underlying weakness is already there. Okay, let's wrap up with a truly unique insight from our sources, one that completely contrasts with this digital, capital-constrained world we've been describing.
Yes, the analog management philosophy at Kyobo Life Insurance.
It's such a refreshing counterpoint.
It really is. While K-Bank is struggling with digital demand, Kyobo, under its chairman, is deliberately doubling down on physical analog values.
And the prime example is the paper calendar.
In the age of ChatGPT and smartphone scheduling, Kyobo is increasing its paper calendar production for 2026 by 18%, from 610,000 to 720,000 copies.
An 18% jump in paper calendars is a true AI analog paradox. What's the strategic thinking there?
The chairman sees the calendar not as some outdated giveaway, but as a deep customer touchpoint. It embodies the core value of life insurance, trust, and what he calls neighborly love.
It's a physical, tangible promise on a customer's desk every single day.
Exactly. That focus on tangible connection has to resonate, especially in a financial climate defined by volatility and digital detachment.
And it seems to be working.
It is. The sources note the calendars are immensely popular. Customers flood their centers with inquiries. They even trade them on used goods sites. It shows there's a premium on these enduring physical gestures of institutional reliability.
And this philosophy applies elsewhere, right, to their actual headquarters.
Correct. The chairman has deliberately kept the 35-year tradition of the Guangwaman slogan, displaying poetry and quotes on the building's exterior, instead of installing giant, modern LED ad screens.
He calls it a cultural window.
It's a powerful statement that stability and legacy can sometimes be managed by reinforcing these core human-centric values, not just by optimizing capital ratios.
So what does this all mean for you? We've seen the Korean financial sector being constrained by domestic regulations, threatened by global currency volatility, and forced into some painful restructuring, all while some players find their strategy in these deeply held analog values.
I think the core takeaway is recognizing the compounding effect of these three forces: policy risk, market risk from foreign exchange, and institutional risk. Maintaining stability isn't about solving one problem, it's about balancing strict loan control with swift, decisive capital protection against threats like RWA inflation.
We talked about the idea that this loan tightening could cause a massive future housing price spike. So here's a final provocative thought for you to chew on. If the exchange rate keeps climbing toward that predicted 1501 range, and this sustained RWA erosion becomes the new norm, which of the four major financial groups, Shinhan, Woori, Hana, or KB, is structurally the most vulnerable to this specific capital erosion mechanism, and why might Hana's specialization in foreign currency actually put it at the highest long-term risk?
Thank you for joining us for this deep dive into the Korean financial squeeze.
Farewell.